All right, today is not a simple silver price video. This is a pressure video, a trust video, a system video. Because when silver starts moving like this, the real story is usually not the metal by itself. The real story is what the move is exposing underneath the metal. Debt, liquidity, yields, panic, confidence, and the very uncomfortable question almost nobody wants to ask out loud. What happens if the system still looks normal on the surface, but underneath it is getting a lot weaker than people think? Because that is where we are right now. And before we go any further, I want to say this clearly. I am not telling you the whole system died this morning. It did not. Banks are still open, markets are still trading, government data is still being released. Social Security has not vanished overnight. That is not the point. The point is that stress can build for a long time before the public recognizes it. And by the time the public recognizes it, the easy options are usually gone. Also, quickly, my stats keep showing me that a lot of people watch these videos and still are not subscribed. So if you get real value here, subscribe now and drop a quick comment, even if it is just John AG, so the algorithm knows this kind of work matters. Now let's get into the real issue. A lot of people look at gold and silver in a very simple way. Bad news happens, metals should go up. War headlines hit, metals should go up. Markets get shaky, metals should go up. And when that does not happen in a clean, straight line, people get confused. Some get angry. Some start mocking the entire idea of hard assets. They say, hold on, if this stuff is supposed to protect wealth, why did it not move the way I expected right when fear showed up? That is a fair question. But it is only a fair question if you assume we are living in a clean, honest, low-leverage system where price discovery is simple and money itself is stable. We are not living in that system. We are living in a system where debt is enormous, where paper claims sit on top of other paper claims, where rates still matter, where funding stress matters, where institutions can be forced to sell what is good in order to cover what is bad, and where the first move in a crisis can look completely backward to people who only know the headline version of safe havens. That is why this matters. Right now, the latest official data still says the machine is functioning. Consumer inflation for February came in at 2.4% year over year, with core CPI at 2.5%, and the March CPI report is not even due until April 10th. Seasonally adjusted M2 stood at about $22.67 trillion in February. The Fed's balance sheet was roughly $6.657 trillion for the week of March 25th. Total U.S. debt was just under $39 trillion on March 26th. And as of March 26th, the effective federal funds rate was 3.64%, with the 3-month Treasury at 3.73, the 2-year at 3.96, and the 10-year at 4.42. In other words, the lights are still on. But the numbers are not exactly calm either, and that is the trap. And that is why I get careful when a script tries to jump straight from "there is stress" to "everything is already dead." That leap sounds powerful, but it can make people stop thinking clearly. The official Social Security trustee summary still says the Old Age Trust Fund can pay full scheduled benefits until 2033, with continuing income covering 77% after that if nothing changes. That is not the same as safety forever, but it is also not the same as pretending the system disappeared this week. Serious analysis has to hold both ideas in the same hand. The system is still operating, and the system is still vulnerable. That balance matters because exaggerated timing can make people tune out real structural risk. If you tell someone the bridge already fell and they can still see traffic moving across it, they stop listening. But if you tell them the bridge is carrying too much weight, the supports are under strain, and the next shock could matter more than people expect, now you are talking like an adult. And that is how I want to frame this. The other thing people miss is that not all confidence breaks at once. Some confidence breaks in prices, some breaks in funding markets, some breaks in housing, some breaks in government debt auctions, some breaks in the willingness to hold long-duration paper at yesterday's yields, and some breaks in the simple emotional willingness of the public to keep trusting that every new rescue makes the system healthier instead of weaker. That process can be slow, then fast. And when it turns fast, availability matters more than theory. That is another reason I watch physical metal closely. If everybody decides at once that they want direct ownership, then the issue is no longer what they wish they had bought months earlier. The issue becomes what can actually be found, what premium has to be paid, how long delivery takes, and whether the product people thought would track the metal is really the same as owning the metal itself. That difference stays hidden in easy times. It does not stay hidden in hard times. And you can see hints of that kind of seriousness in the way professional markets talk about vault data, settlement, collateral, and deliverability. Those are not glamorous words. They are plumbing words. But plumbing is what matters when the building shakes. So yes, keep watching headlines, keep watching price, but also keep asking the less exciting questions. Who owes whom? Who can settle? Who needs liquidity now? Who is being forced to sell? And who is trying to move from exposure to possession before the crowd notices why that distinction matters? People hear the system still works and think that means the system is fine. Those are not the same thing. A bridge can still be standing and still be under too much stress. A company can still be open and still be one bad quarter away from trouble. A currency system can still be operating and still be carrying deep structural weaknesses that only show up when fear, liquidity pressure, and confidence shocks all hit at the same time. So when silver surges, when gold behaves strangely, when yields do not calm down the way people expect, when debt keeps climbing, and when official data still looks stable enough, that does not make the warning smaller. In some ways, it makes it more serious, because it tells you the pressure is building before the crowd fully sees it. And that is what this video is about. This is not a buy because shiny argument. This is not a sell everything and hide in a bunker argument. This is a structure argument, an order of events argument, a what breaks first argument. Because most people do not lose in crises because they are stupid. They lose because they imagine the wrong sequence. They think the first move will look like the final move. They think if there is real danger, gold and silver must immediately act like perfect mirrors of fear. They think stocks go down, metals go up, end of story. But that view ignores the thing that dominates the early phase of almost every real funding scare, the demand for liquidity. And in a debt-heavy world, liquidity often means dollars first. That is the part people miss. If households are over-leveraged, if funds are over-leveraged, if institutions have redemptions, if margin calls start hitting, if borrowers still owe mortgage payments, car payments, payroll, rent, invoices, and short-term financing, then the first thing people need is not a beautiful long-term thesis. The first thing they need is whatever settles the bill right now. That can create a very strange first phase. In that phase, people sell what they can, not always what they want to. Good assets can get sold because they are liquid. Strong positions can get cut because something else is blowing up. A person may believe gold is real money and still sell some of it to survive a cash squeeze. A fund may believe silver has bigger upside and still dump exposure because the phone is ringing and collateral is needed now. That is why the first move can fool people. The first move can be a scramble. The first move can be a dash into cash. The first move can be forced selling in the very assets people expected to protect them. And if you do not understand that, you can look at a short-term drop in metals and conclude the entire hard asset thesis failed, when in reality, the market may only be moving through stage one. Think of it like this. When the tide pulls back fast from the shore, an untrained eye might say, look, the ocean is retreating, the danger is leaving. But the trained eye knows the pullback can be the warning, not the relief. Markets can do the same thing. A crisis can begin with liquidation, not celebration. A monetary problem can begin with a dollar squeeze, not an immediate gold moonshot. And if that squeeze gets bad enough, central banks and governments almost always feel pressure to respond. That response can come through liquidity facilities, asset purchases, emergency lending, balance sheet expansion, backdoor support, direct guarantees, or plain old money creation with nicer branding wrapped around it. Then the next question becomes the real one. Does the market still trust the cure? Because once the system reaches a point where every answer to instability is more debt, more intervention, more support, more balance sheet engineering, more promises stacked on top of old promises, the next crisis is not just about whether the authorities will act. Usually they will. The next crisis is about whether the market still believes those actions restore value instead of diluting it. That is where trust becomes everything. And trust, right now, is the one thing the modern system cannot afford to lose. Look at the debt. Nearly $39 trillion and climbing. Look at the money supply, still massive. Look at the balance sheet, still huge even after years of talk about normalization. Look at rates, not zero, not emergency low, still meaningfully positive, while long yields have also been pushing higher. That combination tells you something important. The system is not in the old easy money dreamland anymore, but it is also nowhere near cured. And that creates a very narrow road. If growth weakens, the pressure for support comes back. If inflation stays sticky, aggressive support becomes harder. If yields rise anyway, financing costs spread through everything. If oil shocks, war risk, or auction weakness keep long rates elevated, housing feels it, credit feels it, and confidence feels it. That is not theory, by the way. Mortgage rates have already moved higher again, with the average U.S. 30-year fixed rate reaching 6.38% this week, the highest in more than 6 months. So now bring silver back into the picture. Silver is not just a fear asset. It is not just a monetary asset. It also sits in industry, fabrication, electronics, solar, and supply chains. That makes it more emotional in both directions. It can run harder, it can correct harder. It can look like a monetary metal one month and like a cyclic industrial metal the next. That is why silver attracts believers, traders, and confused newcomers all at the same time. But when silver starts acting wild in a period like this, I do not just see a chart. I see a signal. I see pressure between paper claims and physical preference. I see stress between the world people were promised and the world that may actually be developing. I see a system where too many claims exist on top of too little truly unquestioned collateral, and that brings us to the paper problem. One of the biggest dividing lines in this whole conversation is the difference between exposure and possession. A lot of people think if they have an account statement, an ETF line, a futures position, a pooled claim, or some other financial wrapper tied to metal, then they own metal in the same way someone holding allocated bars or directly owned coins owns metal. That is not the same thing. Now, that does not mean every paper instrument fails tomorrow. It does not mean every fund is fake. It does not mean every market is 1 minute away from default. Again, we have to stay disciplined here. But it does mean there is a hierarchy, and people ignore hierarchy at exactly the wrong time. When everything is calm, convenience wins. When everything is stressed, direct claim matters more. And if the market ever moves into a real preference for settlement over abstraction, then the gap between paper comfort and physical certainty gets a lot bigger, a lot faster than most people think. This is why physical premiums matter. This is why availability matters. This is why vault data matters. This is why inventory movement matters. As of the end of February, London vaults held about 9,210 tons of gold and 27,065 tons of silver. That is a lot of metal. But the key question is never just how much metal exists in total. The key question is how much is truly available, how much is already spoken for, how much is sitting behind claims, and how much confidence the market has in the chain between quote and delivery. That is where the conversation gets serious. Because in a genuine confidence event, the public does not suddenly become experts in basis trading or liquidity plumbing. They do something much simpler. They run toward what feels final. And what feels final is usually the thing with the fewest counterparty layers. That is why physical metal gets so much attention in these discussions. Not because it pays a dividend, not because it solves every problem, not because it is magic, but because it sits outside a lot of the promise stack that modern finance depends on. That matters more than people think. Now let me slow this down, because this is the point where some channels lose people by going too dramatic too fast. Hard assets are not a lottery ticket. Gold and silver are not guaranteed to make you rich. Owning some metal does not make you untouchable. And a system reset, if it ever gets that far, would not be clean or fun or cinematic. It would be disruptive, uneven, ugly, political, and full of second-order effects no one can map perfectly in advance. So when I say silver's surge may be signaling a bigger crisis ahead, I am not saying the whole thing ends on one calendar day. I am saying the market may be hinting that confidence, collateral, debt, and liquidity are no longer sitting together as comfortably as they used to. And once that process starts, the public usually notices very late. That is why preparation is different from panic. Panic is when everybody realizes the same thing at the same time. Preparation is when you act before the crowd makes your options more expensive, slower, or smaller. That applies to a lot more than metals, by the way. It applies to cash buffers. It applies to debt levels. It applies to where your savings actually sit. It applies to whether you understand the difference between legal ownership and economic exposure. It applies to whether you have any assets at all that do not depend on someone else keeping a digital promise to you. Simple questions. But in a real squeeze, simple questions become huge questions. And I think that is one reason this story keeps building. Because people are starting to realize that the real issue is not, will the price be up tomorrow morning? The real issue is, what exactly do I own? What kind of system is it sitting in? And what happens if the system has to choose between protecting the structure and protecting my claim? That is a much bigger question, and the answer is usually not comforting. The structure protects itself first. That is how these systems work. Now let's talk about the argument that hard asset holders may end up in a stronger position after a major break. This is the part people either romanticize too much or dismiss too quickly. Here's the simple version. Savings is stored purchasing power. Real savings is what allows future production. If a society burns through real savings, misprices capital, subsidizes bad debt, and keeps creating paper claims faster than underlying value, eventually a correction shows up. It may be delayed, it may be massaged, it may be papered over for years, but it shows up. And when it shows up, one of the biggest losses is not just on portfolios. It is on capital formation. People forget this. A functioning economy needs more than consumption. It needs stored up resources that can fund time, risk, payroll, equipment, inventory, shipping, trial and error, and all the waiting that comes before a business becomes productive. That waiting has to be financed somehow. If traditional paper wealth gets damaged badly in a reset, then the people still holding assets the market trusts may suddenly matter a lot more than they did before. That does not mean kings of the world. It means optionality. It means the ability to move when others are frozen. It means the ability to buy when others are forced to sell. It means the ability to support productive activity when paper savings have been impaired. That is one reason hard money people talk the way they do. They are not just talking about price. They are talking about preserving seed capital for whatever comes next. And if you think that sounds too abstract, make it simple. Imagine a local economy after a major credit unwind. People still need food. They still need transport. They still need clothing. They still need repair work. They still need basic manufacturing. They still need local business. The need does not vanish. What vanishes is the fake comfort that endless cheap credit can paper over every bad allocation forever. So somebody has to fund the rebuild. Somebody has to back the useful entrepreneur. Somebody has to provide the bridge between idea and output. In a system where paper wealth has been repriced, the people holding the most trusted form of savings may be in position to do that. That is the core of the argument. Now, do not misunderstand me. I am not saying everybody watching this video becomes a cigar-smoking baron because they bought a few ounces. Let's stay sane. What I am saying is more modest and more important. In unstable periods, preserved purchasing power becomes strategic. That can mean survival. That can mean flexibility. That can mean opportunity. That can mean being able to say yes when everyone else is stuck saying, I can't. And yes, that can matter far beyond metals. It can matter in cash flow decisions, business decisions, family decisions, relocation decisions, even career decisions. Because the people with reserves always have more choices than the people living claim to claim. That is true in bull markets. That is even more true in unstable markets. This is also why I think too many people still frame this subject the wrong way. They treat gold and silver as if the whole case stands or falls on a perfect one-week reaction to a news event. That is way too shallow. The bigger case is about long-cycle trust. The bigger case is about whether debt can keep compounding faster than underlying productive reality. The bigger case is about whether central banks can keep rescuing markets without slowly teaching the market that rescue itself is inflationary, distortive, and confidence-draining. The bigger case is about whether the public will continue to believe that digits, promises, and rollover mechanisms are equivalent to final savings. That is the case. And in that case, silver's move matters because silver tends to exaggerate pressure. It is emotional. It is thinner. It is more violent. It often says the quiet part out loud before larger systems admit anything is wrong. That is why it gets my attention. And it should get yours too. By the way, the March CPI report is still not out until April 10th, so anybody acting like we already have fresh March inflation proof in hand is talking ahead of the official release. I always want to be careful there because this channel is not about mixing good instincts with sloppy facts. We can be early without being careless. That discipline matters, especially now, because there is a huge difference between the system is invincible, which is false, and the system is gone already, which is also false. Reality sits in between. Reality is that the system is functioning today, but it is carrying serious weight. Reality is that trust still exists, but it is not limitless. Reality is that intervention still works, but maybe not as cleanly as it used to. Reality is that debt keeps getting larger. Reality is that rates are no longer free. Reality is that higher financing costs hit households, governments, and businesses differently, but they hit all of them eventually. Reality is that the public is usually late. And reality is that once late becomes crowded, crowded becomes expensive. That is why I keep coming back to sequence. First confusion, then scramble, then policy response, then a new argument about what is real, what is liquid, and what is actually safe. And if the policy response is big enough, long enough, and confidence eroding enough, the final phase becomes a trust event, not just a market event. That is when hard assets stop being a niche hobby and start becoming a reference point. Not because everybody suddenly loves coins, because people stop trusting abstractions. That is the shift. Now, one more thing that I think deserves more attention. Too many people assume this subject is only for rich people, hedge funds, or people with giant stacks in a vault somewhere. I do not think that is the right way to look at it. The real question is not whether you can build some fantasy position. The real question is whether you have any layer of savings at all that is not purely dependent on the same fragile structure everyone else is depending on. That is a more reasonable question. And for a lot of people, the answer right now is no. Everything is inside the system. Everything is paper. Everything is digital. everything is custodied, everything is priced through other people's liabilities. That might be fine for normal times. But if this period is moving toward a more unstable phase, then even modest diversification into things the system cannot print instantly starts to make more sense. Again, modest, thoughtful, not performative, not panic-driven, and not because one headline scared you on a Wednesday afternoon, because the structure itself is telling a story. Heavy debt, sticky inflation, a still massive money supply, a huge central bank balance sheet, long yields pushing higher, mortgage pressure rising, vault inventories being watched closely, and silver acting like the market is wrestling with something bigger than a normal clean growth narrative. That combination deserves respect, not hysteria. Respect. And if you are one of the people who has actually navigated a tough cycle well, built something, protected capital, or made smart moves when everyone else froze, share that in the comments sometimes. Seriously, people read those stories. And your experience can help someone else think more clearly when the mood gets noisy. Now let me address the biggest pushback. What if none of this becomes the giant collapse some people expect? Fair question. Then what? Then you still learned something useful. You still learned how the system is put together. You still learned the difference between liquidity stress and long-term value. You still learned not to confuse a working structure with a healthy one. You still learned that debt matters, rates matter, and claims are not all equal. You still learned that resilience has value even if the worst case never fully arrives, and that is not a wasted lesson. Insurance always looks boring right before it matters. Preparation always feels unnecessary right before it matters. And patience always looks foolish right before it matters. That is just how these cycles work. So no, I am not here to promise the exact date of some final reset. Anyone doing that with confidence is usually selling you theater. What I am saying is simpler than that, and in my opinion, more useful than that. Watch the structure. Watch trust. Watch yields. Watch liquidity. Watch how metals behave when fear collides with forced selling. Watch whether policy responses calm the market or slowly make people question the currency more. Watch whether temporary support keeps becoming a permanent feature. And watch silver, because silver has a habit of turning hidden pressure into visible drama. That is why this surge matters. It may not be the whole story, but it may be telling you the whole system is under a lot more strain than the average headline reader realizes. And for me, that is the real takeaway. Not that paper dies tomorrow morning. Not that gold and silver only move in one direction. Not that every scary prediction instantly comes true. But that the modern system is built on confidence, leverage, refinancing, and rollover. And when those things start getting stressed at the same time, hard assets stop looking old-fashioned and start looking like a form of independence. That is the bigger crisis signal, not the metal alone. What the metal is hinting at. If you want the faster updates, join the WhatsApp channel because that is where I can post quick follow-ups when the story moves during the day. And by the time you are seeing this, the members-only video should already be up, so join the membership if you want the full update trail in one place, the deeper breakdown, and to show who is really following. So here's the question I want to leave you with. If the system gave us one more big liquidity scare tomorrow, would you rather be holding assets that depend on layers of promises or assets that sit outside a lot of those promises? And second, do you think silver's recent behavior is just volatility, or is it flashing a warning about the next phase of this debt-heavy system? Drop your view below. And if you are doing well in your own life, in your own business, in your own investing, share some of that too once in a while. A lot of good people read this comment section quietly. Your story can lift somebody more than you think. Take care, stay sharp, stay early.